After nearly 40 years as a financial planner, fund manager, and private investor, I've seen every mistake in the book. And many of those mistakes I've made myself. From people putting their entire pension into one tech stock because their cousin's mate said it would go to the moon, to people panicking out of the market the day before a rally. But here's the truth. You don't need to be brilliant to get rich. You just need to avoid being stupid. And today, I'm giving you the 7 golden rules that consistently make people wealthy. Welcome back to Tony Talks Money. If you're new here, my name's Tony Byrne. I've been a UK independent financial advisor for almost 4 decades. Don't the years fly by? I manage money, invest in property, and run businesses. And I created Tony Talks Money, this channel, to help you become financially free without the nonsense. Let's get straight into it. Rule number 1, only invest in what you understand. Warren Buffett sums it up, and he's only worth $100 billion, so he might know something, don't you think? If you can't explain how an investment makes money in one sentence, don't buy it. I've seen people invest in companies they can't pronounce, crypto projects run by cartoon avatars, guaranteed return schemes, always a red flag. If you wouldn't buy a business you don't understand, don't buy a fund you don't understand either. Ignorance is expensive, very, very expensive. Let me give you a modern example. In 2024, many investors piled into AI-themed ETFs, which is a type of low-cost fund, without understanding holdings like illiquid microchips suppliers that tanked 40% in 2023. Always read the fact sheet. If it looks like rocket science, it probably crashes like a rocket too. Peter Lynch, the famous investor and author, wrote an all-time classic book, which he called One Up on Wall Street. Now, admittedly, it was 30, 40 years ago, but what he said in those days still applies today. He preached about investing in what you know. Today, it might be Netflix, Amazon, Apple, and so on. If these are the businesses that you use, there's certainly businesses I use, and I like all these companies. I've personally invested in Netflix about a year ago, and my Netflix holdings are about 80%. It's just incredible. I invest in that business because I love Netflix, and I love the fact that they have their own content. They produce their own films and series. I just thought the quality was high. I like the fact they don't advertise. So that had a major effect on my personal investment into that company. So companies that you know, you use, you understand, and you rate very highly. Netflix, I think, is a good example. Rule number 2, maximize your ISA allowance every year. What is an ISA? Individual savings account. It's in the UK, but you have similar types of products in other countries, like the US, for example. So for UK investors, this is a no-brainer. In the tax year 2024 to 25, you could put £20,000 per person into a stocks and shares ISA. That's £40,000 for a couple. We're now in the 2025-26 tax year. It's the same for stocks and shares ISAs. And everything inside it grows free of income tax and capital gains tax. So invest £20,000 a year into a stocks and shares ISA for 20 years, and at a 7% per annum compound return, it becomes £820,000 free of income tax and capital gains tax. That's fabulous, isn't it? Now, what if it was outside of an ISA? If it was a taxable investment in stocks and shares, the same investment would lose you tens of thousands of pounds in tax. Remember, your ISA is not a pot, it's a tax fortress. Rule number 3, I really like this one. Don't let the tax tail wag the investment dog. What does this mean? This is a saying I've used with my clients for decades. In other words, a bad investment with good tax relief is still a bad investment. So don't let the tax tail wag the investment dog. People chase these sophisticated schemes in the UK like EIS, VCT, CDIS, offshore bonds, not because they understand them, but because they heard you get good tax benefits. Well, yes, you do. The benefits can be fantastic, but not if you still lose money. What's the point in getting great tax reliefs if you still lose money? Because the entire loss of your investment won't recover all the tax savings you've had. It's a bit like buying a terrible car because road tax is cheap. Don't make any sense, does it? Rule number 4, Understand risk. Now, for me, most definitions of risk aren't really about risk. They're more about volatility. In other words, the zig and zag of your investment where it goes up and down in value. If you invest in stocks and shares, they will fluctuate in value, but usually like this on an upward trend. They'll fluctuate up and down, but going upwards long term, normally in a portfolio of stocks. They won't all succeed. Some may fail. So don't make investment risk or volatility your enemy. Expect it as part of the game. What you want to do, whenever there's a reversal, a stock market correction or a crash, as long as you still believe in that company and you've done your research, treat it as a Black Friday event. Buy more. But obviously, if the whole game has changed and that company's no longer got very good prospects, then you should sell. Cut your losses. Don't worry about it and move on to another company that's got better prospects. Most investors panic with volatility, with prices falling. But volatility is the price you pay for high returns. If you want stability instead, open a bank savings account and enjoy earning 1% or less a year. Okay, your money's safe, but it's not safe from inflation. It will still lose value in real terms. Now, when you're looking at investment funds, look at a fund's volatility score. It's technically called standard deviation, if you want to sound clever at dinner parties, but it's really just volatility, the amount by which the zig and zag of the investment. So compare it to the sector average of volatility for at least the last 3 years and maybe 1 year as well, just to check. If the fund has high volatility, it swings up and down a lot, but a low return, then just avoid it altogether. If it has low volatility and a high return, it's probably what's called a unicorn, a small company that's growing. I would investigate that because it's uncertain how it's going to perform in the future. If you have average volatility for the sector you're in and the returns are consistent, then that's probably a solid choice. The most important thing is to understand your own appetite for investment risk. Everyone is different. Don't follow other people's tips, even when they're an investment expert. In my experience, whenever you follow anyone else's tips, it usually goes wrong because you've got to have the same personality, the same timescale, the same attitude to investment risk as the person making the tip. And I've myself fallen for this with my personal investments. I've lost money trying to follow an expert's tips because it's not me. You've got to make the investment based on you and your personality and your appetite for investment risk. Rule number 5. Don't put all of your eggs in one basket. In other words, diversify. Don't invest in one company's shares because there's a great risk if that share fails and you lose all your wealth. The world's greatest ever investor, Warren Buffett, is attributed with making the statement, don't put all of your eggs in one basket. But rather confusingly, he was also quoted as saying, put all of your eggs in one basket, but watch that basket very carefully. However, you can only do this if you have the time, inclination, and skill. And when you really think about it, who are the wealthiest people in the world? All the wealthiest people are self-made men and women who have built giant companies, and they do have all their eggs in one basket, don't they? Think about it. Think about companies like Amazon, Microsoft, Apple. People who create these companies, they have all their eggs in one basket, but they're watching that basket very carefully. They're working in it every day. That's the way to do it. Rule number 6, use the rule of 72 to understand investment growth. Now, this is a really lovely, simple rule of thumb formula for working out how long it takes, how many years it takes to double your money. So what you do, you take the number 72 and divide your annual return or your annual interest rate into the number of years to double your money. Let me give you some examples. If you get a 7% return, think about it, 72 divided by 7, that comes to 10, just over 10. So your money doubles in 10 years. If you have a 10% return, 72 divided by 10, just over 7. So it doubles in just over 7 years. If you compare that to bank interest rates, now I know you can get up to maybe 4%, maybe 5% in the UK, but most people, let's be honest about it, are lucky to get 1% interest. If your money's in a bank earning 1% interest, it will take it 72 years to double your money. That's 72 divided by 1. So everyone can become wealthy if they give the money enough time and invest in the right assets. Rule number 7, if you're investing in stocks and shares, invest for at least 5 years and preferably 10 years as a minimum. Stock markets reward the patient and punish the impatient. If your time frame is less than 5 years, you're not investing, you're speculating. Over any 10-year rolling period of the FTSE 100 share index or the S&P 500 index, the market is almost always positive, and these returns almost always beat cash. Only very rarely do they fail. Probably 95% plus a probability. If you go to 20 years, it's 100% probability that you'll beat cash with a portfolio of very good shares. I'd say at least 10 in your portfolio and probably more. So when you're investing in stocks and shares, it's not fast, it's not exciting. You could even say it's boring. Investing isn't supposed to feel like you're in a casino. You get your excitement there, but you ain't going to win any money. You're bound to lose money. It's supposed to feel like watching paint dry until one day your portfolio is worth more than your house. Then you won't find it boring. Conclusion: read, listen, learn from others. I recommend the Intelligent Wealth podcast. Well, I would say that as I'm one of the presenters, but you'll learn a lot from that because we review different companies every month and give you ideas to help you with your research that might help you pick good companies. If you want me to cover investment tips, pension strategies, tax tips, or property insights, all based on my 40 years of real work experience, make sure you press the button and subscribe to Tony Talks Money. You know it makes sense. Remember, wealth isn't about luck. It's about rules, self-discipline, and patience. Thanks for watching. I'll see you in the next one.